Talk Money.
Hello and welcome to another brand new edition of Let's Talk Money with me, Surabhi Upadhyay. Interesting subject at hand today. Hybrid funds offer a way of taking care of the asset allocation part of our portfolio planning. That's one less decision to then keep in mind. Now, there is a whole host of these funds. Some have well over 65% in equity. Some are mostly investing in debt. And some of these funds also invest in commodities. So how do we know which hybrid fund is right for us? Today on the show, we will be discussing all of these different hybrid categories, the tax calculations involved, and the suitability of investment for different age groups, different risk profiles. Our guests on the show today are Dinesh Balachandran of SBI Mutual Fund, as well as Shyam Sunder of PeakAlpha Investments. Gentlemen, thank you so much for joining in. Great to have you on. I really want to keep this as simple as possible, because the problem with hybrids is that, it has so many other subcategories under it that it can leave the investor a bit confused. So let's ask ourselves the most basic question. Why should we look at hybrid funds when we can play equity via pure equity funds and debt via debt funds? So, Dinesh, let me, set the ball rolling with you first.
Great. First of all, thanks for having me over. Now, when I think about hybrid funds, I think one basic requirement for hybrid funds is the fact that when people think about equities, they understand that equities represent one of the best ways to generate wealth over a long-term time frame. But there are many risk-conscious investors who really worry about the drawdowns. So, for example, the moment, let's assume the portfolio goes down by 10-15%, a lot of people really get scared, right? And that thought itself prevents them from being actively involved in the equity markets. This is where something like a hybrid fund really comes into the picture, because you are targeting these risk-conscious investors, where you are telling them that instead of keeping all your money in fixed deposits, why don't you invest in a hybrid fund which has a combination of equity and some other asset class? Normally it's fixed income. The combination of these asset classes leads to a return profile which is much more comfortable for these kind of investors, where the drawdowns are going to be much lower. You can't completely eliminate drawdowns, but definitely it's going to be lower in magnitude. And it makes you sort of sleep more peacefully at night. And from that perspective, I think hybrid funds, I think the industry has done a good job in terms of catering to these kind of risk-conscious investors, in my opinion. Also, when I think about people who already have investments in pure equity funds or a combination of equity funds and debt funds, the biggest advantage there for hybrid fund is that, one, when you try to balance dynamically between equities and fixed income, as an individual investor, the tax hit that you're going to take is much higher.
Because you'll have to sell down your equity fund.
You'll have to sell either equity or fixed
debt,
income.
and then buy another fund.
Right. So the tax hit is much higher, right? On the other hand, when you are essentially putting your money in a hybrid fund, and assuming that the fund manager actually does a good job, the allocation becomes sort of like quite dynamic in nature. And normally, fund managers have a prudent approach in terms of how they want to sort of keep dynamically allocating between equity and fixed income. That way, you don't take the tax hit, and your portfolio is being sort of dynamically managed. So that is definitely a benefit for a lot of investors.
I think the second part of what you said is something people will immediately understand, because nobody wants to pay additional tax, right? It's the first part that should be our first sort of thought when it comes to the portfolio. That, I think, is coming under question, because who is thinking of drawdowns these days, right? Let me take that question actually to Shyam. Shyam, you tell us, you interact with so many clients, right? The market has gone just one way in the last couple of years. So are people really asking themselves that risk question? Is my portfolio geared to take in a 15% drop?
When people see markets like the one that we are in right now, there's a level of greed that kicks in. And at those levels of greed, essentially, they would like to put in more money in addition to what they already have in equities in the portfolio. Compare that with what happened in 2020, and when the markets really fell quite sharply, people would like to take money off the table. So if you ask any investor what they would like to achieve, they'd say, I would like to achieve a behavior of buy low, sell high. But actually what ends up happening is that they end up buying high and selling low because of these emotional factors. And I think that's the role that a hybrid fund can play in a customer's portfolio very well, because it protects them against this instinct of buying high and selling low, because the fund automatically rebalances within itself. And as a result of that, that part of the portfolio, you're able to protect against the customer's most adverse instincts, if you like.
No, absolutely.
So yes, with the market being at the kind of levels that it has been for the last couple of years, some concern is there, but I would say that more than that is the desire to participate and the fear of missing out. And that's where we like to position hybrid funds from that perspective.
Yeah, absolutely, Shyam. Valid points over there. I mean, these are the behavioral aspects that maybe, a product like hybrid funds can guard us against our own sort of behavioral idiosyncrasies. So let's talk about now how to go about it and the categories. Let's just understand the range of funds which are under this broad head of hybrid. And Dinesh, help us out over here, because like I said, that you have some funds which are going up to 60-70% equity, some are as low as 30% equity, and then there is an in-between category. So just at an industry level, how do you guys categorize this?
So normally we group hybrid funds into three main categories. The first category is hybrid fund where the equity allocation is greater than 65%. The second category, or the middle category, is one where the equity allocation is between 35% and 65%. And the third category is one where equity allocation is less than 35%.
Okay.
That's the categorization from a broad perspective. If you want to think about the nuances within each category, greater than 65% is meant for people with higher risk profiles, where essentially they are willing to take higher risk bets, but they are not fully comfortable going to 100% equity.
Okay.
So this 65% equity is for that kind of investor base, where over a long-term time frame, you are supposed to generate pretty good returns, essentially.
And because these funds end up maintaining at least 65% equity, if not more, they also get equity taxation,
yes, so that's the other key aspect of it, that these funds have an equity taxation, which definitely is a plus in the current landscape.
And the sort of funds, if we talk about the names of the subcategories that fall under this, would be?
These funds are called equity hybrid funds. Okay. So the first category is normally equity hybrid funds. The second category essentially has three types of hybrid funds, where it can either be a balanced advantage fund, or an equity savings fund, or a multi-asset allocation fund.
But wait, if you go back to the first category, there's also something known as aggressive hybrid. So Shyam, come in on this as well, because I know that you like this category, the aggressive hybrid category. So is it the same thing? These are funds maintaining more than 65% equity, which is why they're called aggressive hybrid?
Yes, that's absolutely right. So if you think about the aggressive hybrid funds, they are required to maintain greater than 65% of their portfolio in equity. The reason, there is another category of fund that is quite comparable to it, which is the balanced advantage fund. In that both of them are, in our opinion, slightly more aggressive funds, like Dinesh said. I'll just talk about the difference between these two categories, but these, along with the arbitrage, tend to be the most popular categories. They have the highest AUM with them today. But the difference really between the aggressive hybrid funds and the balanced advantage funds, which I think people can think about in comparison, is that the aggressive hybrid fund is a simple category. There's only equity which is greater than 65%, and the remainder tends to be in debt. The reason this is simple and attractive is because you know kind of what you're getting. With a balanced advantage fund, it's quite an innovative and new category in which what you tend to see is the combination of the use of arbitrage as well. So while equity taxation mandates that you have 65% or greater in equity, a clever usage of arbitrage in these funds enables the fund manager to decide, given the current market valuations, what is the appropriate level of equity they should have. So let us say we are in a situation right now where people feel like the valuations are starting to feel a little stretched. So the aggressive hybrid fund manager does have no option except to remain invested to at least 65% in equity. Whereas if you have a balanced advantage fund, what you end up having there is maybe 50% of straight equity and the remainder being made up using arbitrage. So the net equity level can be below 50%. But the gross equity will still be greater than 65.
So basically,
in essence, you retain the equity taxation, but you have a safer portfolio compared to an aggressive hybrid fund.
Got that. And, that perhaps makes it one of the most popular categories. I want to put up the stats, the numbers again. I think we had them on a while earlier as well. If you look at hybrid funds as a whole, it is the balanced advantage category, which has the greatest AUM as per latest industry data, AMFI data. This category, the total AUM is almost now touching 3 lakh crores, I mean 2.85 to be more precise, but it is the most popular and the largest category within hybrid funds. And also, remember, balanced advantage funds are that second category that Dinesh you spoke about, right? Which basically run portfolios that could have equity between 35% going up to 65%, right? So what is your thought about a BAF, and which are the other funds in this in-between category?
Right. So balanced advantage fund, as Shyam mentioned, it ticks all the boxes that you're looking for in a hybrid fund, right? One, where you have a combination of equity and fixed income. Two, you have equity taxation. Three, the asset allocation is being dynamically managed, which means that when markets are overheated, you will have lower directional equity allocation, and when markets are attractive, you will have higher equity allocation, right? And no wonder it is the most popular hybrid fund category. For us, when we compare balanced advantage with the equity hybrid or an aggressive hybrid category, balanced advantage scores from a risk profile perspective. It tends to have better risk profile than equity hybrid. The other two categories in this middle sort of bucket are the equity savings funds and the multi-asset allocation fund. In the case of equity savings, you are categorically saying that the equity allocation is going to be in that 35% range, more or less. It will be between 35 and 45% for the most part, right? So it tends to have a sort of lower risk profile compared to a balanced advantage fund or an equity hybrid fund, but it also enjoys equity taxation because again, you use arbitrage to get to that 65% level essentially. That's the equity savings fund. The third fund, which I find it to be very interesting, is the multi-asset allocation fund. Because here you're not restricting yourself to just equity and fixed income. You're saying that there is a third asset class out there, basically precious metals or commodities, which tend to have very different behavioral characteristics compared to both equity and fixed income. So when you add that to the mix, I think it definitely offers diversification benefit in the base case scenario, and it can also provide superior returns in certain environments. So that's the third sort of category, multi-asset allocation
which
fund.
You can look at. And finally, the third broad category is funds that have less than 35%, and they're treated like debt funds from a tax point of view,
yes,
right?
so the conservative hybrid funds or the debt hybrid funds, as we call it, they tend to have less than 35% equity, and the taxation is essentially very similar to what we have for pure debt mutual funds, essentially.
Got it. So now we have understood all the different categories of hybrid funds and what kind of portfolios they run. The question is, how do you decide what's right for you? We answer that after the break.
Let's talk money.
Welcome back. You are with us on Let's Talk Money, and this week we are trying to figure out how to make the best use of hybrid funds to provide very well-informed asset allocation to the portfolio and also keep your portfolio fairly tax efficient. So let's keep the conversation going. I have a question for Shyam, because Shyam just told us that he actually likes the balanced advantage fund category quite a bit. But Shyam, my question really is this, that maybe different AMCs will have a different algorithm or a different formula or a different model that BAFs follow. So, how do you know which one is the best? And, since we're on the subject, if you could tell us any one or two or three balanced advantage funds that you like. Sure.
The new element that comes in with the balanced advantage fund is this model. And when you have the model in place, then it is possible that the model might get it fantastically right, but it's also possible that the model may get it wrong. So if I look across the fund houses, I think the one fund house that has been an exception to the pattern has been HDFC, where their balanced advantage fund has reasonably consistently done better than their aggressive hybrid fund. But apart from that, as I look across fund houses, I find that more often than not, the aggressive hybrid fund has done better than the balanced advantage fund. So if I look at ICICI, for instance, or Edelweiss, for instance, their aggressive hybrid funds have done better than their balanced advantage funds. Whereas if I look at the 5-year returns with HDFC, HDFC's balanced advantage fund has done better than their aggressive hybrid fund. So I think it's worth keeping in mind that conceptually, the balanced advantage fund has the ability to time the market better than an aggressive hybrid fund, in that they can reduce their equity exposure quite meaningfully if they feel that that is an appropriate strategy. But what we've seen in the last 5 years in terms of the performance itself is that the aggressive hybrid funds have done better than balanced advantage funds in most fund houses.
Okay, fair enough. Dinesh, come in on this. So for someone who is young, who will primarily have a bulk of their portfolio in, let's say, pure equity funds, but for whatever reason wants to look at one of these two options, either the equity hybrid fund or the aggressive hybrid fund, as it's also known, or opt for a BAF in order not to get too carried away and too swayed by, you know, rising equity markets. What should the choice be between these two categories? Both have equity taxation, right?
Yes.
So how do you decide what's better?
Right. So particularly for someone who has already a significant amount of equity exposure and is looking to sort of diversify away from that, I would recommend balanced advantage fund. With the simple reason being that from a drawdown perspective, you will always find balanced advantage funds having a much better drawdown profile compared to an equity hybrid fund. Yes, aggressive hybrid funds deliver better returns. But then when markets go down, they are also likely to sort of have bigger drawdowns. And this is the basic premise of a balanced advantage fund, that when it comes to drawdowns, you should have much better drawdown profile. So for an investor like that, I would definitely recommend a balanced advantage fund, or a third fund, which would be essentially a multi-asset allocation fund.
Because where you also bring in an element of commodities.
Commodities. And I think my personal belief is in this decade, inflation expectations, stagflation, these are phrases that are likely to become more popular. And in that kind of paradigm, in that kind of regime, it is important to have that diversification that commodities essentially bring into the table. And
let's also talk about realistic return expectations. So, you know, there's aggressive hybrid, there is balanced advantage, and there is the multi-asset category. Taxation-wise, all three are more or less equal because these funds, the strategies will ensure that you get equity taxation. In terms of return profile, what's the range? What should investors realistically keep in mind?
The way I think about it, low double-digit returns should be the basic sort of return profile over a long-term time frame.
For all three,
for
aggressive,
all three.
Hybrid, BAF, as well as multi-asset.
The key is really in terms of the downside aspect, where, as I said, an aggressive hybrid might actually give you slightly better returns, but particularly when I try to adjust the downside aspect, then essentially they all sort of fall in line. And in my opinion, the question that an investor has to ask is, what kind of person am I? Am I someone who gets troubled by a 10% drawdown or not? If a person is like that, then automatically you have to sort of veer towards the more conservative hybrid funds. On the other hand, someone is saying that I really am trying to sort of maximize returns within a certain constraint. There, then obviously equity hybrid would be or the aggressive hybrid would be the right choice, essentially.
Fair enough. Okay, so now let's actually talk about that conservative investor, because not everybody is comfortable taking a lot of equity risk, and you know, you do want to have a fair amount of fixed income exposure in your portfolio as well. So again, gentlemen, here let's go back to a category. So you can be in category B, but B with funds which have you know, slightly lower equity exposure and they don't have equity taxation, but you want to sleep peacefully at night, so you're okay to pay more tax. And then there is the last category where the equity allocation is even below 35%. So here, which are the fund categories that you would recommend for such a low-risk investor, Shyam?
I think one of the categories that has become quite popular now is the equity savings category, because again, you know, through the clever use of arbitrage, they've been able to maintain equity taxation and yet maintain fairly conservative portfolios where the net equity exposure tends to be 30% or even less in some cases. So we really like this category because, like you said at the beginning, Surabhi, everybody wants to pay lesser taxes if they can. So from that perspective, if you have a conservative investor who wants to maintain fairly conservative funds in their portfolio, then rather than having straight debt funds in the portfolio, the equity savings funds have become quite an attractive category. And that's principally because of this tax advantage that they have, where through the clever use of arbitrage, they are able to maintain very conservative, safe portfolios and yet enjoy equity taxation. So we feel that this is a category that is likely to continue to become quite popular in the days ahead, the equity savings fund category. And just like Dinesh was saying, the very comparable thing to that is the multi-asset funds as well, because you do get the additional correlation benefit, which is when equities go down, gold or other commodities have a history of doing quite well. So you tend to get a better outcome as a result of that. So it is starting to become quite difficult to make a case for a straight debt fund compared to a fund like an equity savings fund because of this tax advantage it enjoys.
Fair enough. Dinesh, comment on this. Again, I'm talking about the profile of a person who's either retired or approaching retirement, definitely wants better than FD, tax-efficient returns.
Right.
What's the kind of fund they should look at?
Yeah, so there are two options. One is the equity savings fund that Shyam just spoke about. The other one would be the conservative hybrid fund or the debt hybrid fund that we, as we call it. So there, again, the only issue is the taxation is one of fixed income taxation.
For the conservative hybrid?
It's a marginal tax rate, yeah,
right.
for conservative hybrid fund.
Yeah.
So now, depending on the tax bracket that an individual falls into, that can be a big concern, or maybe it's not as much of a concern.
Yeah.
The advantage is that the conservative hybrid fund or the debt hybrid fund essentially will have equity allocation normally in the 25% range.
Okay.
Which means that, again, from a sleep well at night kind of perspective, it is a very apt fund for such investors essentially. So either that or the equity savings fund that Shyam spoke about, because that also tends to be a very conservative fund in general.
Okay, great. I think this is really, really helpful. So as we wind down, gentlemen, let's just, recap the things that we investors need to really ask ourselves when we are looking to invest in a hybrid fund. Dinesh, to sum it up, why do you need it and what should we ask ourselves before deciding which one?
Yeah, the number one question is diversification, whether you want diversification and the benefits that it provides. Equities represent the best ways to generate wealth over a longer time frame, but it comes with drawdown risks. So a hybrid fund helps from that perspective. So when you think about risk reward, hybrid funds definitely add something to the equation. Two, from a taxation perspective, when someone has investments in FD, I think on a post-tax basis, you can easily get better returns in a hybrid fund. And from that perspective, it's actually, in my opinion, sort of a surefire thing that you are better off in a hybrid fund compared to FDs for the most part, essentially.
And Shyam, 30 seconds left on the conversation. Things to ask before picking the right hybrid fund.
I think one of the things that an investor needs to be careful about a hybrid fund is making sure they know what they're getting. So it's important to look carefully at the equity part of the portfolio. Is it large cap? Is it mid cap? Is it growth? Is it value? What kind of portfolio is held within equity? And exactly the same question to ask also about the debt part of the portfolio. Is it long duration, medium duration, short duration? Is it a high credit quality portfolio? Is it a AAA or a AA? What is that? So it's important to look a little bit more carefully about the constituents of the portfolio. But apart from that, for the tax advantages it brings and the automatic behavioral adjustment, I think this category, the hybrid funds category, has a pretty important role to play in customers' portfolios.
All right. Thank you very much, gentlemen. I think this is a lot of food for thought and a lot of very sensible advice as well, right? Why not look at a more tax-efficient way of managing our portfolios? Thank you for joining in and giving us all the insights. Shyam as well as Dinesh, good to have you on the show.
Thank you.
Thanks so much for having me.
All right. Well, with that, it is curtains on this edition of Let's Talk Money. Thank you for tuning in. And remember, keep sending us your feedback, comments, queries, and questions. See you again next week.
Let's Talk Money